Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. So I had a client reach out last week relative to our weekly piece where we write about term premium. And he said, explain to me this notion of long end rates relative to short end rates and long end rates taking the place of potential short end hikes. And what we try to explain is look, it's confusing. And I think a lot of people are confused when the Fed and the central bank, they start talking about long end rates. But in the end, long end rates are really a function of short end rates. And then we talk about term premium on top of that. And for a long time, we really didn't have term premium because the Fed was involved in the markets and they were buying and suppressing term premium and volatility. And those dynamics are changing now. So we talked a little bit about that. And we certainly talked about the notion of financial conditions. And we were a little surprised that the Fed was so explicit about financial conditions in their last statement because we know the Fed is driving financial conditions in really both directions, and they're driving that with real yields. And we know the role that the long end plays in that. And we see the volatility, obviously, on the longer end of the curve. So you can get whipped around, just like market participants are subject to getting whipped around in this environment with financial conditions in really both directions. But nonetheless, in the end, it does come down to financial conditions, and it comes down to financial conditions being tight enough to bring inflation down to target. So, good luck finding a magic formula for that. There doesn't really exist to be one, but in the end, that's what the Fed is saying. And we're not going to do a one for one. There's no magic formula, but having some term premium back in the marketplace, we see the deficits that we're running right now. We see what Moody's did. I mean, this stuff is in the marketplace. I'm not saying anything that people aren't seeing. We write a lot about this stuff, and we've been very vocal about the fiscal side of the equation. And in our weekly this week, we do compare early 2021 until now, where we saw a lot of position unwinds, real yields moving higher, volatility, a function of term premium, obviously moving higher, duration hitting the market, and a high sensitivity to the fiscal side of the equation back then when we passed the $2 trillion Rescue Act. So these things are relevant. What's different now than then is somewhat obvious. The Fed back then went back to buying mortgages and treasuries, and now we're right back to running the balance sheet off, which is an important dynamic moving forward, perhaps more important than the rate story, which market participants now have largely embraced that the Fed is likely done here. But we need to see the economy slow. And we don't really see much of a difference between Powell's presser and what you heard in the speech. If you look at both side by side and get in the weeds, the message is kind of clear. We think we're there. We may be there. We're likely done. But at the end of the day, if we need to do more, we will. And the disinflationary forces that we've seen come from the supply side of the economy, I think they need to see growth slow here. We need below trend growth, and growth has really surprised to the upside. Take third quarter GDP out. We know that was an anomaly, and we're going to slow from there. But certainly brings into focus the employment side of the equation. We are seeing cracks. Certainly, you look at the household survey, you look at continuing claims, which are still relatively low, but they've been ticking higher. You look at the number of full-time employed. You look at a lot of different variables right now on the employment side. You do start to see cracks. This week we'll get another claims number, and like I said, we're honed in specifically on continuing claims. And to see how those numbers evolve going forward. But the Fed does need to see the economy slow down here. That is a clear and concise message from them. Last week, Kansas City Fed, they put out a nice piece on the balance sheet, which we think is important going forward. RRP, TGA, bank reserves, Dallas Fed put out a piece on that, how the balance sheet evolves in terms of the liability side. And then in terms of the asset side, you look at 13.3, how they used in March, the potential for the Fed to use or utilize those types of programs going forward, something we coined the new Fed put, 4 or 5 months ago, earlier in 2023. These are important dynamics. It really was the Fed balance sheet that drove this process through the pandemic. And perhaps now it's the Fed balance sheet that moves more front and center as the rate story is not necessarily over. And we don't question the Fed's resolve to do more, but certainly seems to be taking a more of a backseat as we look forward into 2024. On the ground this week, Front and center will be CPI. Friday, we did see inflation expectations move up in the Michigan survey. Higher inflation expectations consistently over time is something that will get under the Fed's skin. We're not quite there yet. They're still talking about anchored inflation expectations, but that did tick up, so we'll keep a close eye on that moving forward. Additionally, we get PPI and we get a plethora of housing data. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.